This is a podcast from the Business Times.
I can tell you there's never time and it's not uncertain. There's always uncertainty. There's always volatility. So whenever any investor says, look out for volatility, uncertainty, it's a redundant thing to say because it's always been uncertain.
On Monday, 5th August, the stock sell-off deepened across Asia, driven by fears that the US might be heading toward a recession. This led investors to flee from risk assets, speculating that interest rates would need to be cut rapidly to stimulate growth. Japan's Nikkei 225 stock average plummeted 12.4%, marking its worst day since the Black Monday crash of 1987. On the other hand, the recent surge in the yen was initially seen as a positive sign for insurers and banks expecting to benefit from higher rates. The drop also comes as a surprise, given the Federal Reserve was expected to cut interest rates as early as September, or perhaps even sooner. Given these conflicting signals, is the Asian stock sell-off a result of sentiment-driven panic, or does it indicate an impending recession? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And helping us today to unpack what exactly happened and what we should be doing going forward is Paul Chu, Head of Research, Phillip Securities Research.
There were probably two news that actually affected the market. We had, of course, the whole yen carry trade unwind. But the issue is how does a Japanese yen decline actually hit the equity markets, especially in the US? So the key was the transmission mechanism. Not to go into details. So in the US, there's lots of risk parity funds. Basically, these are funds that look to target the lowest volatility. So as a result of that, in very layman terms, when volatility spikes, they basically have to sell equities because to them, equities has suddenly become very volatile and risky. And their target is not returns, it's actually volatility. So then you get this pro-cyclical selling of equities by such funds. But as things start to calm down, you see the sudden stock selling on the equities fund. Of course, in the meantime, you had some weak payroll numbers coming up from the US. Then investors start to begin to worry of a recession coming in. But this is like a slingshot, or the market these days are swinging between recession and non-recession. So every week you're going to have this gyration from one data point to another data point without having a recession or not.
But Paul, as investors, we've been taught not to look at just one data point, right? Overall, how is the situation looking and how concerned should we be?
As an investor, you should react to the direction, to the underlying trend. Short-term events tend to be more flow-driven. So to give you an example, there was probably a margin call on these yen trades. So you virtually can borrow yen and margin it and buy some yen equities. But as you know, what happened was there was a 20% dip in equities in the Nikkei. And as a result, you had obviously margin calls and so forth. So that has unwound. But as an investor, you have to bypass these near-term flows and look at the underlying macro conditions. The backdrop for us is, yes, US is slowing down. All data points point to it, but we do not think it is on a path to recession. A bullish scenario is that you might have a scenario where the Federal Reserve cut rates not only this year, but also 2025. So let's say you assume the Fed cut rates 3 times this year and maybe another 3 times or 4 times next year. That is going to be very bullish for risk markets. And the best scenario is if the Fed cut rates because inflation is coming down, not because economy is going to a tailspin. So we think that could be the scenario as we enter into 2025, rather than no recession, sell equities, just skew everything into bonds.
Some are saying this Asian sell-off has its roots in the US AI boom. What are your thoughts?
I think compared to the US, the sell-down in Asia was relatively benign, excluding Japan. Of course, that was the epicenter. I think on the AI front, our general view is that in the near term, the demand for AI, which I'm referring more towards essentially NVIDIA, we think this can carry on until at least the first quarter. So, of course, why we say the first quarter? Because what we think, our prognosis is that these major big tech buyers of AI GPUs, which is your usual Microsoft's, your Facebook, Google, they will probably buy the latest iteration, which is the H100, and they will move into the latest, where the so-called Blackwell chips, which we think they were probably going to roll out in the first quarter. Then thereafter, our suspicion is that we could see a bit of slowdown in the capex spend, because they've already acknowledged that all this AI spending, the returns are still a bit unknown, and they already acknowledged that they are overspending. So it's just a matter of time where they will have to kind of slow down their AI spending. It's very hard to pinpoint when, but we think the run could be at least up to the first quarter of next year. I'm referring to more the whole thematic and the whole bullish scenario around AI.
Obviously, investing in AI is relatively new, Paul. Is there a historical precedent for similar market reactions? And what lessons can we draw from past events to understand the current situation better?
The closest would be the internet boom in 1999. Even the macro conditions is quite similar. So for the internet scenario, that was when, because the internet started, if you can remember, the four horsemen, Cisco, which is similar to NVIDIA, where they built the infrastructure around the internet that we have today. So this is very similar to what NVIDIA is doing. They are building the infrastructure around AI. One way you can measure is in the US, they have some data points on telco spending as a percentage of GDP. And these levels are actually right now quite similar to the 1999 levels. We have seen this phenomenon before. But as a result of all this spending, thereafter, of course, you get these huge big tech companies, like your Amazons, your Googles, that can leverage on this infrastructure. Of course, the unknown, the jackpot lottery ticket that we're all trying to find is the so-called the next Google and Amazon. Right now, there isn't a real strong application that is riding on all this AI infrastructure. It's working on the fringes. Everyone is just trying it out. But for us, I think it's a bit too early to pick a winner on terms of the application on top of this AI infrastructure.
Still to come. What else can we take away from the dot-com boom of the late 90s, and what should we do now with regard to our portfolios and investments in the face of these uncertainties? More with Paul Chew from Phillip Securities in a moment.
Partnering you on your wealth and investment journey.
Bringing you insights to make well-timed market moves.
Sharing actionable personal financial tips.
Helping you protect and grow your wealth.
Analyzing Singapore's market trends and corporate issues.
Supporting you through your Singapore property journey.
Insights from your trusted partner, the Business Times podcasts. Are you listening?
And now, back to Money Hacks from the Business Times.
We've been talking about the crazy big sell-off in Asia at the beginning of August, and so far, it's not sounded as bad as we might have thought. Paul Chew is head of research at Phillip Securities Research, and he was just drawing parallels to the dot-com boom back in the 90s.
This AI infrastructure is going to be extremely cheap, just like when we had our internet. In the early years, it was expensive. But right now, all this Gen AI infrastructure that we are relying on can be open AI. And because if you look at Facebook just announced Llama 3 as to be a free product. It's essentially giving it free. So how do you compare with something that is zero cost? So it's going to almost very similar parallels to what happened during the internet, where it becomes so ubiquitous and so cheap. But the thing is just to find who are the application winners. Then on the macro similarities in 1999 is that, as we entered the late 90s, Japan was the new superpower where the economic conditions was weakening. And we had something similar that has happened in China. And of course, in 1999, it was all about the US. And again, we're also having some similarities to the US. And of course, in the background, you have all this hype and bullishness around technology. So I guess this is just another observation, at least on the macro front and not just on the AI, compared to what has happened in the previous cycles.
Paul, we're going to have to also discuss how the interconnectedness of global markets exacerbated or alleviated maybe the current downturn in Asian stocks.
I think in the next 18 to 24 months, the macro backdrop will be a global easing of monetary conditions. Basically, a sophisticated way of saying interest rates are just coming down. In that scenario, some of the asset classes that has really underperformed, the most natural pick would be like REITs. They've underperformed since the Fed started raising rates in early 2022. So we think those are the assets that one should be looking for, or basically any income yielding assets. We think that would be another area where investors should be looking at, because our view is that we think inflation might come down sharper than what the market might expect, and that will give the Federal Reserve room cut even more. So, our mindset now is maybe 3 rate cuts, but what if we get 5 rate cuts, 6 rate cuts? Then we have to consider what are the asset classes that will perform. So that is our general view.
Ooh, what else should we look for in terms of shoring up our portfolios, hunkering down for more volatility, protecting ourselves from downside risks, so to speak?
If you're looking for income-producing assets, the most natural would be REITs. The second would be short-dated bonds, and not so much long-dated, because short-dated, I'm talking maybe the 2-year, the 5-year bonds, because of the yield curve inversion. Because right now, the 10-year yield is actually lower than the 2-year or 5-year because of the inversion. That's why we think probably shorter-term dated bonds is probably a sweeter spot for investors if we do get this deceleration in interest rates.
You know, it sounds like it's always volatile. And every time I ask someone, so what should we do as we navigate uncertainty? I feel kind of stupid.
I can tell you there's never time and it's not uncertain. There's always uncertainty. There's always volatility. So whenever any investor says, look out for volatility, uncertainty, it's a redundant thing to say because it's always been uncertain. And so the best investment strategy, if you're not a constant observer of the market, where even us constant observer of the market also get it wrong, would be either 2 ways. So you can either do dollar cost averaging, we still think is a really rational way because it essentially disciplines you to invest. Something like even property, why do people sometimes invest property? Because it's almost like a forced savings. So if you do dollar cost averaging, it disciplines you to save. You inadvertently are able to buy into stocks or whatever asset class that you fancy at cheaper prices because it's the same dollar value, but you're buying more of it. So that helps. The second thing is to buy virtually the most bombed out, the most oversold assets. So just to give an example, when there was a Ukraine conflict, the best time to buy Europe was then, especially the banks. And you actually have an advantage over fund managers because fund managers are assessed virtually by quarter and they actually have to be invested all the time. So even though when these opportunities may come about, they may not be able to take as much advantage as a retail investor because they're always 95, 99% invested because they cannot have cash drag. They cannot have like 5% or even 10% of their assets in cash. Otherwise, their investors will be complaining, I didn't give you this fee to just put money into cash.
What would your advice be then? So it's always uncertain, always volatile, yada yada. We're just retail investors, can't be institutional investors with deep pockets.
So you have the advantage. You have the advantage of opportunistic acquisitions where you can actually wait. So as a retail investor, you have a lot of advantage. You can just wait. If you don't like it, then just wait. And when things get any major sell down, then you just come in, which a lot of funds cannot do that. But the problem is most retail investors are momentum. Everyone is temperamental. Everyone is emotional, which is natural. You will get into buying at the tops and missing out at the lows. As an investor, you eventually have to, especially for a young investor, I think you eventually have to pull the trigger sometime. As much as we explain to a young investor what to buy, you still have to go through this emotional ride. Maybe your stock or your investments might drop 20, 30% and still have the willingness and discipline to hold it because you probably have a strong view around it. So my advice is that if you're a young investor, to start early because you need to go through this emotional ride. Because most times when things are down, you end up just selling it and probably that's the worst time.
Thank you, Paul Chu, Head of Research at Phillip Securities Research. Next time, what do you need to prepare as you think about moving out? Dum dum dum. I'm Howie Lim, and this has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.